The secret of RBI's earnings: how does it become a crisis manager for the government? Imagine the country's budget is in front of you. The government has to build roads, run schemes, manage debt, and uncertainty in the world is increasing. Just then news comes: RBI has decided to give record money to the government. The question starts right here. How does the institution that prints notes, controls banks, and keeps an eye on inflation earn money itself? And why does it then give a large part of its earnings to the government? The fear is that the government might be depending too much on RBI's money. And the curiosity is whether the RBI actually becomes a silent rescuer for the government in times of crisis. In common parlance, people call the RBI the country's biggest bank, but in reality it is not a commercial bank. It is India's central bank, whose job is not to earn profit but to keep the economy stable. RBI is the banker to banks, banker to the government, currency issuer, and the guardian of the financial system. It is the same institution whose one policy can make a loan feel expensive or cheap. But the interesting part of the story is that earning profit is not the main aim of the RBI, yet it has several sources of income. This income comes from its normal operations. RBI does not give dividends to the government, but in technical language it transfers surplus. Meaning, after keeping expenses, provisions, and risk buffers aside, the surplus that remains is given to the central government. This transfer is not a favor. Under the rules of the RBI Act, after making provisions, the remaining profit has to be given to the government. That is why this process runs within a legal and institutional framework. Now, here enters the Economic Capital Framework, or ECF. It decides how much risk buffer the RBI will keep for itself and how much surplus can be transferred to the government. Think of the risk buffer in simple language as a rainy day fund. If there is a shock in the market, a sharp fluctuation in currency, or stress in the financial system, then it is necessary for the RBI to have a cushion. In the latest record, RBI approved a surplus transfer of more than approximately 2.86 lakh rupees crore for 2025. Before this, approximately 2.69 lakh rupees crore was transferred in 2024. This is the reason why it has been called a big fiscal cushion for the government in the news. When the government gets more non-tax revenue, it can help in reducing borrowing pressure. But where does RBI's income come from? Its first big source is foreign exchange reserves. RBI has assets like dollars, euros, gold, and foreign securities. These foreign assets do not just lie in an empty locker. They are invested in safe foreign securities, from where interest income and returns can be obtained. When global interest rates are high, income from foreign securities can increase. This is the reason why many times RBI's foreign income appears to improve sharply. The second source is foreign exchange operations. When there is sharp movement in the rupee, RBI tries to smooth volatility by buying or selling dollars in the market. If RBI bought dollars at a lower rate earlier and sold them at a higher rate later, an accounting gain can happen. But this is not trading for profit. It is part of currency stability. The third source is government securities. RBI keeps government bonds and treasury bills in its balance sheet. The interest received on these securities contributes to its income. Open market operations, or OMO, is also a part of this story. RBI buys and sells government securities in the market so that liquidity and interest rate conditions can be managed. If there is excess cash in the system, RBI tries to absorb it. If liquidity is tight, RBI supports the banks. Both income and costs are created from these operations. Banks can take liquidity from RBI when needed. Through tools like repo operations, RBI gives short-term funds to banks, and interest income can be received on that. But it is necessary to understand that RBI does not do customer business like a private bank by giving loans to banks. Its purpose is to maintain stability and liquidity in the banking system. Now comes the matter of printing notes. People say that RBI prints a note for a few rupees and its face value is very high, so RBI makes a huge profit. This is half the truth. In reality, a currency note is also a liability for the RBI and there are assets behind it. There is the benefit of seigniorage, but considering it a simple printing profit is wrong. Currency printing also has costs. Notes are printed, transported, old notes are replaced, and security features are updated. Meaning note management is also a major expense. RBI also provides some banking services to the government and banks. Fees and charges related to government accounts, debt management, settlement, and payment systems can also be a small part of the income. But RBI's real earning power comes from its assets. Foreign securities, domestic securities, forex operations, and liquidity management together make up its income profile. Now the question is, when income comes, why is the entire money not given directly to the government? Because RBI also has to take care of its own risks. RBI has market risk, currency risk, interest rate risk, operational risk, and also financial stability risk. Provisions are necessary to protect against these. If RBI keeps a very small buffer and a sudden global shock occurs, its credibility could weaken. Therefore, a balance between surplus transfer and safety buffer is necessary. This is the reason why the CRB discussion becomes so important. If the buffer is kept higher, the government will get less surplus. If the buffer is kept lower, the transfer can be larger. In the latest transfer, the CRB was maintained at the 6.5% level. This means the RBI gave a record surplus to the government, but also kept its risk cushion within the framework. Many people ask, if the RBI can give money to the government, then why doesn't the government take unlimited money from the RBI? The answer to this lies in inflation. If the central bank starts funding government spending by creating money without discipline, the value of the currency can weaken and inflation can rise. Therefore, RBI's surplus transfer and money printing are two different things. Surplus transfer is related to earned income and the amount remaining after provisions. RBI's main duty is price stability. If inflation goes out of control, it has the biggest impact on the common man's pocket. When pulses, oil, milk, school fees and loan EMIs start feeling expensive, then RBI's policy decisions directly touch the household budget. This is the reason why considering RBI as just the government's cashier is wrong. RBI is an independent monetary authority, which has to look at the long-term stability of the economy. For the government, RBI's surplus is valuable because it gives revenue support without increasing taxes. It can be seen as non-tax revenue in the budget. If the government gets extra revenue, then theoretically borrowing can decrease. If borrowing is less, the pressure on the bond market can reduce somewhat. But this is not an automatic guarantee that interest rates will fall every time. The market looks at many things together, like fiscal deficit, inflation, global rates and liquidity. Both the stock market and bond market keep an eye on the RBI dividend. If the transfer is more than expectations, the market can consider it a positive fiscal signal. If the transfer is less than expectations, investors ask what its impact will be on the government borrowing plan. Therefore, RBI surplus is not just an accounting number, but also a market signal. Now, why is RBI called a crisis manager? Because when there is stress in the economy, RBI provides liquidity, guides banks, handles rupee volatility, and maintains confidence. Whether it is a global crisis, a shock like a pandemic, or tension in the banking system, RBI's role is seen in the background. The common man sees the headline, but the real work happens in the system plumbing. When there is panic in the market, trust becomes the biggest currency. RBI's job is to keep that trust saved. But if RBI's activity increases in every crisis, then its income can also increase. Forex operations, securities management and liquidity tools become more active. Even then, it would be wrong to say that RBI is sitting to earn profit from a crisis. It manages the crisis, and in that process, sometimes income looks higher. RBI's profit should not be compared with the profit of a private company. A private company works for shareholder value, RBI for monetary stability and public interest. For the government, this surplus is definitely helpful, but it is not a permanent solution. Government finances get strength for the long term, only through strong tax collection, disciplined spending, and sustainable growth. If any government expects an extraordinary surplus from the RBI every year, it will not be considered a healthy signal. The central bank's balance sheet is also a part of the country's financial credibility. Therefore, there is a delicate balance between the RBI and the government. The government needs resources, and the RBI has to protect its independence, credibility, and buffers. Now understand this with a family example. Suppose a father has kept an emergency fund in the house. After the year's expenses, if some money is left, he gives it for household chores. But if he spends the entire emergency fund, the family will become insecure in the next crisis. The RBI's buffer is also a similar safety reserve for the country. The RBI first looks at its expenses and risk provisions. Then, as much surplus as can be safely transferred, it gives to the government. Therefore, the big dividend seen in the headlines is not just a story of earnings. It is a combined story of risk management, asset returns, forex operations, and policy discipline. Foreign reserves have a big role in RBI's earnings, But these reserves are not kept just for profit. They are also necessary for rupee stability, import confidence, and protection against external shocks. If the dollar becomes strong in the global market or there is tension in oil prices, RBI's reserves give the country breathing space. Gold reserves are also a part of the RBI balance sheet. But the increase in gold prices does not mean that the entire gain goes to the government as cash profit. Many gains are visible in valuation, not in distributable income. It is important for the common viewer to understand this difference. RBI's accounting is different from simple business accounting. Here, every asset, liability, reserve, and risk has a macroeconomic meaning. Therefore, when we hear that the RBI has given a record surplus, we should not just stop at the amount. We should also see in what environment this surplus came. If foreign income remained strong, forex operations remained active, and surplus was left after provisions, then the transfer can be large. But there is no guarantee that the same amount will repeat next year. RBI's income can depend on market conditions, global rates, currency movements, and policy operations. Now, what does this news mean for a common viewer? Money will not come directly into your account, but it can indirectly impact government finances and market sentiment. If the government's fiscal position looks better, then investors' confidence can improve. If confidence improves, it can impact borrowing costs and the investment mood. But this all happens gradually. The RBI dividend is not a magic button, but an important support pillar of the financial system. The most interesting thing in this story is that the RBI is seen less, but it has a very big impact. It appears in the headlines only at the time of dividends, but listens to the heartbeat of the economy every day. When banks need liquidity, the RBI stands by. When there is pressure on the rupee, the RBI watches. When inflation increases, the RBI changes its policy. This is the reason why the RBI is called the government's crisis manager. But more than that, it is the stabilizer of the economy.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.